Or are there still bets to be had here? Our next guest seems to think so, at least that there's other opportunities within tech. So we're going to talk about some of those potential names like Viacom and IBM. Joining us now is Sean O'Hara, president at Pacer ETFs. Sean, FAANG alternatives, what do you like and why?
Good morning. Thanks for having me. It's valuation driven for us, and it's free cash flow based. We use a strategy that measures free cash flow yield, which is essentially the free cash flow you receive on an annual basis divided by the total enterprise value of a company. It's just a different way to measure value. Tech is expensive right now. The Nasdaq's at 38 times earnings. And so you can buy, for example, a name like IBM, which trades at less than half of the forward PE to the tech sector. You buy a company that's starting to move towards the cloud, which is a very profitable business. They generate huge amounts of free cash flow. And so if you're looking to play cloud, but you don't want to play cloud at these elevated valuations, look at a name like an IBM. If you look at streaming, which is, a big business and growing here, Netflix is the big player in that space, but they're sort of growth constrained going forward. They've got 200 million subscribers here in the U.S., and in order to grow those numbers at the rates that they have, they either have to increase the number of subscribers dramatically or increase their rates, which they probably can't do in this market. But you have two names that screened into one of our ETFs that are entering the streaming business, CBS, Viacom, and Discovery Network. Both interesting plays, both generate a lot of free cash flow. The CBS Viacom story is one where, they've raised some cash. They own content via Paramount. And then the Discovery story is really a low-cost input streaming service because they're reality-based. I mean, who doesn't love Mike Rowe and Dirty Jobs? And so you don't necessarily need to move away from the tech space. What you need to do, at least going forward, we think, is you can enter some of these growing tech opportunities, but by buying different names that are trading at a discount to the overall market and that are generating a lot of free cash flow today.
Yeah,
and that free cash flow is important in a rising inflation environment. Growth will get hurt by that. Getting a current return on your money is where you should be if you're going to see inflation rise.
No doubt, Sean, it's David. But, there is a reason sometimes that stocks are cheap. I mean, for example, IBM, and I'm not here to pass judgment on it, but they're being challenged in a lot of different parts of their business. There are a lot of people who are concerned about the erosion of market share that they have, and certainly their legacy business, not to mention even their debt load. I mean, there is occasionally the market is right in paying a low multiple for certain things, despite the fact that it may be generating a decent amount of cash flow.
Yeah, I agree. I mean, the cash flow is what we measure here, and so that's what caused us to own the stock. They have had a troubled past, if you will. It looks like they're starting to focus themselves on different businesses. They're shuttering some and selling some assets off. But, $20 billion a year in free cash flow gives you a lot of opportunity and a lot of options, and perhaps maybe, they'll surprise everybody and start to get it right from here on forward.
Shepard Smith here. Thanks for watching CNBC on YouTube.